Kia ora and welcome to the Can podcast. I'm the host, Warwick Slow, and today's guest is Simon Rolland, who you might know from his time at Aurora Financial. He's recently started a new entity where he's helping financial advice businesses acquire other financial advice businesses. And in terms of people with that type of experience in New Zealand, I don't think there can be too many who can compete with Simon on that part. He grew and sold Aurora Financial, and he goes into great detail that entire process and why the most important part is the exit and planning for that. We also talk about what most things that financial advisors get wrong about becoming business owners. And he also dives into great detail about how to grow a financial advice business, right into the scripts that you have your team when they call new clients, hiring the right staff as well. This is like an amazing resource for any financial advice business owner or anyone wanting to run their own financial advice business. So I think you get a lot of value from it. And if you do get enjoyment or value, please give us a subscribe or a follow. It goes a long way to helping us grow this resource. But otherwise, let's get into it. Simon, thanks for joining us today.
Thanks for having me.
I'm going to use a quote that you've said previously to,
Oh, no.
not against you.
Okay.
You've said it starts with the exit.
Definitely.
Tell us a little bit more about that.
Yeah. Okay. Well, luckily we've got a bit of time to talk, right? So, my mindset when I came into this industry initially was, how do I set up a business where I can bring in my mates and we can all help clients and make money, right? That was the initial sort of brief. But the older I got, the more I kind of realized that actually there's an opportunity to build something, scale it and exit it. And then my mind started going, well, if I'm going to be building a business that's going to be of value, what's it going to be like when I sell it? And this is where I actually call it the checkmate theory. So sort of through studying, I did some investment banking courses when I was 29, having a bit of a career crisis going, where am I going to go and what am I going to be? But what I basically taught myself was at some stage in the future, you are going to be sitting across the table with someone who's wanting to buy your business, right? So I'm the seller, you're the buyer. And from day one of me starting any business that I'm involved with, I'm already visualizing this chat where me and you are sitting opposite each other on the table and going, well, I want to sell my business and you want to buy it, but your incentive is to try and get it for as cheap as possible. My incentive is to try and get it, sell it to you for as much as possible. So what I wanted to do was go through a thought process that goes, okay, we're in this conversation. What moves, like we're playing a game of chess, can I make that will counter any moves that you will make so we can get to the price that I essentially want to sell the business for? So that then guides my strategy, right? So my strategy became, if it starts with the exit, I can work backwards to today. Because as business owners trying to grow a business, they go like this, right? Up, down, around, left, right, back, front. But to kind of guide the strategy from day one, it was, will this decision we're making today equal a higher enterprise value or an exit price in the future? And if the answer is, well, option B is going to mean that it's a bigger check other than option A, then even if option B is a harder decision to make or harder to pull off, that's the decision we make. So if you start with the exit, you know who's going to buy you, when they're going to buy you, what they're going to pay for you, and what you can do to make that check higher, then that really starts to guide and become the sort of the framework or the blueprint of how you can make smart decisions and build a good strategy for building something of actual value.
Like an A to Z business. Like what is that if you describe it?
So what does an A to Z business mean to me, right? When we built our software for Aurora, I called it the IKEA method. Have you ever been to IKEA?
Yeah, I had been.
Yeah.
Had the meatballs.
Yeah. I can't remember what I had, but all I remembered was I came in the front door. I had to walk through every aisle. I couldn't just shortcut to the way out, right? And that's what I mean. So our software was built that it takes you from A all the way through the alphabet to Z. So in a business context, what does that mean? It means that you have every piece of the puzzle in-house. You control it, from the start of the supply chain to the end. So in our case, that was things like, we owned our software. That was a really important piece for us back in the day. We owned our marketing team. Very, very important to control that lead supply. So you knew the quantity, the quality, you could turn it up, you could turn it down, left or right. That was a big part of the value of our business. We then owned all hey, this is how you make a phone call. This is how you quote a client. This is how you present an offer. This is how you submit the deal. This is how you service that client. This is how you do training. Every single part of their career was mapped out and bespoke to our business. So what else? We owned the clients. We owned everything, and that's so we could control it and maximize the most value for the enterprise. Well, the most enterprise value for the business for the next buyer.
So looking like really far down the road, like how can that affect things like multiples when you come to sell? Because a lot of companies, they'll be going, oh yeah, I'm a mortgage or let's say an insurance advisor. Like what can it look like if they start to think more holistically when trying to frame their business's overall proposition value?
Yeah, excellent question. So I guess the first thing is to really understand is, am I building a book or am I building a business, right? And that's really comes down to, do I own a business and I'm a business owner, or am I essentially just self-employed? So once you have the first one, and often if it's a lifestyle business, it's more of a book. But if you're actually looking at building enterprise value in your advice firm, then you should be trying to create a business. Now, what does a business have? A business has IP. A business has systems. It has processes. It has clients. It has a track record of doing things over and over and over again, whether that's been acquiring new clients, servicing clients, upselling clients. And that's what you kind of want to make sure that you're creating. Because at the end of the day, when you sit down with the potential buyer of your firm, if it is essentially a book, well, the book's going to determine the value. The size of it is going to be whether you get a low multiple or a high multiple. The average age of the client and the product mix is going to depend if you get a high or a low multiple. Your quality, so the persistency level, especially in insurance, is going to really, determine if you get a high multiple or not. Because the past performance of your book and your business is an indicator of the future performance of your book or business. So it's no good getting to the finish line and saying, hey, I'm ready to sell. And, oh, I was about to do all that good stuff for my business. I was about to go back and put in that system. I was about to do all this. It's too late. So what I really do and what I focus on when I'm, working with people is going, all right, we're having that chat. We're having this game of chess. We're doing that where I'm going, well, I want to sell my business for X. You probably want to buy it for less, but what can I do in the meantime to make sure that, I win this negotiation?
And you had a very low, or I say young, demographic of customers.
Yeah.
How can that affect things when it comes to selling?
Well, I mean, do you know what LTV is, the lifetime value? So I was pretty obsessed with the lifetime value of products. And if you look across the KiwiSaver insurance and mortgages, the highest LTV is KiwiSaver. You'll earn more money over the lifetime value of a client from KiwiSaver than you will from insurance or mortgage, which is not what everyone believes or not what everyone thinks. The second thing is, if I'm 35 years old and I've already bought my first home, well, I'm going to be in your KiwiSaver fund for the next 30 years, right? There's no way out, essentially. Insurance, if I'm 35 years old, I've probably got, young kids or just starting to have kids. So I've got probably 20 to 25 years worth of insurance left in me. Mortgage, if I'm 35 and I've just gotten a 25 or a 30-year mortgage, well, I've got 25 or 30 years left to go. On the flip side, if I am 60 years old, my kids have left home, so there's no real need to support that, financial need there. I've probably paid down my mortgage, or at least close to having no mortgage. So my insurance is very expensive. It just means that they're not going to hold it for long. So that lifetime value of that client, even though the premium might be high, the future value of that revenue stream is low. So therefore, that will be reflected in the valuation of which multiple you get, whether that's a book multiple or if you have built a business and you are getting an EBITDA multiple.
And in terms of the marketing, like, did you guys do a bit of analysis in terms of like your customer acquisition cost? Like, because that must be quite a hard one to balance it'd be easier if you've got the marketing, but it'd be a hard one for other businesses to balance.
Good question. When you started saying that question, it reminded me, like when I did a marketing paper at uni, and essentially all I remember from that marketing paper was like, if you can spend $1 and make 5, spend 10 and make 50, or spend 100 and make 500, and you basically just keep adding zeros, and that's all we did, right? So we worked out that for every, again, making up round numbers here, for every $100 we spent on leads, we would make $400 to $500 in revenue, and therefore we would grow our business by, X amount of dollars, and then we would just continue to keep those ratios, but just adding zeros onto the end of the budget every month.
Money printing.
Well,
100%.
yeah.
And so the other part that I've heard other people talk about is, instead of getting valued as a multiple of your trail book, it's a multiple of EBITDA.
Yeah.
Like how can that play out when you get to that point?
Yeah, well, where does that line, right? The real good question is, where does that line go from, hey, I have a financial advice firm that's valued off the book, to where does it then transition into where I'm valued off an EBITDA? And there's not an exact science, but the rough rule is, what percentage of the revenue comes from your personal exertion? So if I'm the owner or the founder or the director or the CEO, if kind of more than 30% of the revenue from the business is coming from your personal exertion, then it's more of a business. Does your, is most of the staff your family or friends? Then it's probably going to be a book multiple. Is your revenue kind of in that 500,000 to 1 million? That's where it's starting to become more likely to be a business. Russell Hutchinson always says, if you go away on holiday and your business makes as much money as before, then you probably have a business. And the question was, once he said to me, he was like, "Hey, if you're on holiday, does the payroll still get done?" And I said, "Well, yes, it does." But back in the day, it was when my finance manager was on holiday, she still had to do the payroll. So once she had to do payroll when she was overseas, because that was her job. I mean, she didn't mind. She just log in and get it done. But yeah, so, and for me, right, I knew I had a business when I was overseas, and I would make more money than my European holiday would cost. So while I was away, I earned more than that whole trip cost. And actually, I remember one time, and it was kind of that nice pat on the back moment, was went away and we had our best month ever. And I was like, that's great. If I can be overseas and we have our best month ever, we're on the right track. We're
Imagine
doing
what we
good
can do
things.
if I leave the business.
Yeah. Well, exactly. Hello. And that's what you tell them, the potential buyers, right?
I think a lot of people would find that as well. Like they'd be like valuing a company, and they might look at a really key member of the team and go, without you here, this business, would not perform the way that it has been.
Yeah, and 99% of advice firms are that, right? If the managing director or the main advisor left, that would be a huge percentage of that revenue that comes in. It'd also be a huge network, right? Because a lot of the sub advisors who work in these sort of small to medium sized business generally work the offcuts from the main advisor, right? The main advisor, I'll take every big deal, you take my smaller deals. But essentially, it's that main advisor who's still bringing in that. So obviously, it's a bit hard to read that from just looking at a set of financials. But when you start interviewing the business that you're looking to buy, and you go, hang on, if Warwick leaves, he did 250K API last year. That's 500K of revenue. We only did 800K of revenue. 200 of that was from the trail. If he goes, hang on, what's left?
Liability.
Yeah. And actually, I was at a roadshow the other day, and a lady in the crowd asked the question. She said, will my admin team add value or subtract value from my future exit of the business? And I again said, it's that first question. Well, if it's a book, they probably don't add any value. If you're selling a business and you can prove that you're profitably, servicing those clients, onboarding clients, and all that will continue if you're gone, well, then it's an asset. So it really depends on a lot of factors.
And if someone's buying that business and they're just taking the book and they've got amazing processes and systems, they've all got their own admin team, that is really just like a liability or an expense to the business that they might not want to continue with.
And a lot of people are very inefficient, right? So a lot of people get cushy, and like we've all been there, right? You get to know your employees, and you let them get a little bit slack and a little bit more relaxed and a little bit friendly, and after a while you're like, oh, hang on, we probably need to tighten things up. But it's hard to once they're used to a certain lifestyle and certain cadence, that to bring it back into line. But a new owner might just say, hey, I'll take the book and you guys can unfortunately the admin staff are gone. But someone else might go, well, I'll take your admin staff because I need people who are trained. It's really lots of things can happen.
There's lots of people who are looking for admin staff, so there's always like a pretty tight, solid market for that type of opportunity.
Yeah, admin staff is an interesting one. I was having a chat with a guy about that this morning. I don't think it's a good sign that you have so many, if a business has lots of admin, right? To me, that's a lack of software solutions, processes, and systems. If you, have one advisor and they've got 3 or 4 admin staff, yet they only do, 1 or 200,000 a year, or maybe 300,000 bucks of revenue, I'm just going,
What's the point?
what's the point? Yeah, like you're just any money you were making, you're just giving it to your admin staff. And it's why can you not do more of the process? It's not that hard. Most of it these days, like, you've got a great CRM. It's pretty easy to fill in the forms. Clients send you the supporting docs, whip it off to the bank or the insurer, and, a bit of back and forth and it's done.
Jobs are good in.
Yeah. I don't know what people are doing for 40 hours a week.
Yeah, me neither.
Yeah.
Now, the other part was how can you show like a potential buyer that, say you've got someone in the company, like the example you gave, they're writing, like a considerable amount of API versus the overall business's amount of API.
Yeah.
How do you show that they're going to be loyal to the business in the event of a sell? Or what is
The clients?
clients are important as well, but also showing that like key staff are important to the loyal to the business. So that when someone buys, that person doesn't go, I'm just going to go do my own thing, or I'm going to go work my mate down the road instead.
Yeah, well, that's a huge risk, right? Like if you're an advisor looking to exit and you're not retiring, getting out of the industry, moving to somewhere else, like out of the country, that's a real risk when buying it, because what will stop you from coming back in? Because then it's like comes back to what's the motivation? Why are you selling this business? Oh, you've got some debts you want to pay down, or you owe the IRD some money, or you're just a bit tired and a bit burnt out. But if you fill up the bank account again and have a couple months off, the last thing someone who's just paid you good money for that business wants is that you get back into the industry and start going, it's a bit tight. I might just, hey, Warwick, I ran into you at the pub or at the golf course, and how's that new advice? Oh, he hasn't called you this month. Oh, I would call you every month, mate. That's not good advice, is it? The amount of like shit chat from advisors that you hear, but that's what they'll do. And then suddenly the new products come out. Oh, mate, why don't I can help you be like the old days. The guy's going, oh, thanks, mate. I thought you said you were a man of your word. So yeah, be careful. So again, if you're not genuinely leaving, not genuinely retiring, be upfront about that, but don't expect to get a premium price. But for me, if I was, if I'm looking at a business, what I want to see is, does it run without the founder? Does it run without the main owner? Even if it does, okay, is he or her paying themselves the same wage I'd have to pay someone else? So sometimes people underpay themselves, right? Because they think, I'll just say I get 140K a year and, well, look, my profit's high and times that and, it looks good. But then you're like, well, actually, for the size of your business, for the experience you'd need, I'm going to have to pay someone 200. So actually, let's take 60K off that net profit figure or the EBITDA before we multiple. So don't get tricky about that. Be honest about it. And then you also want to create a business that someone else can step into, or it can plug into something else. Like if your business can plug into something bigger, if they've already got an HR team, they've already got a marketing team, but you've got 2 or 3 of, good bits of the puzzle, then you can go, hey, listen, my bits are very good, but they'll make you even more money in your structure of your business. So it's a no-brainer. So you get a good exit and they get a good buy.
Win-win.
Win-win.
So if you were starting today, round 2, what are the key things that you'd set up in a new advice business that would maximize that potential sale price?
Yeah, good question. Well, I'm lucky that the Aurora Financial, one of the businesses I sold, we got probably 90% of it right. Yeah, so I wouldn't change a lot. I would change a few things, but it'd be just small nuances. Probably one thing that I would change is, and especially if I was going to start today, and I do a bit of consulting to some people, and KiwiSaver is the product with the highest lifetime value. I think the KiwiSaver Gold Rush is still happening. It's hard to pull off to actually create a KiwiSaver advice business, because it's not like insurance where you get these large commissions that you can kind of cash flow the business off. Mortgages, again, it's high cash flow, but longer sales cycle, smaller ongoing value to the business. But KiwiSaver to me is actually the sweet spot. So I would be building a business that was centered around KiwiSaver, and then every other product behind it, not being a mortgage advice firm that sells a bit of insurance and upsells a bit of KiwiSaver. It would be a KiwiSaver advice firm that has a little bit of insurance or mortgages behind it. Yeah.
There's still a lot of advisors and they look at KiwiSaver and they go, not worth my time.
Yeah. which for me is it's typical of the industry. People don't know what game they're in, right? Like, it's been funny. I've been on a roadshow around the country the last couple of weeks, meeting some advisors who are either interested in growing their business, interested in selling their business, interested in buying businesses. And it just really reminded me of why we did so well, is because most advisors have no idea how to gain value in their business, have no idea what game they're actually in, and are too focused on, oh, I call up some mates and give them good advice and, ask for a referral. And then next month I go out and I do another sale and, well, I've got 3 admin staff, to make my life easy. And it's just like, you're not building anything of value here. Like, you've got a nice lifestyle and that's fine. But for me, if your actual aim is, no, I want to build a business of value and I want to build something that's sellable at some stage, it doesn't have to be tomorrow, but you need to start thinking about that now. So yeah, that's how I guess, yeah. So to answer your question, it would be KiwiSaver focused would definitely be the way I would go. I would continue to do the model that we did in the past, which was salaried advisors. A lot of people ask me all the time, salary versus commission. To me, commission drives bad habits, bad behaviors, but also it's very rare the kind of person who can be an advisor long-term on commission and actually build a successful career out of it. You get a lot of burnout, you get a lot of tax issues, and the reality is most people aren't good at advising, good at managing a business, good at managing their taxes, good at managing their cash flow, and good at getting leads, like there's too many pieces of the puzzle they need to be good at. So definitely creating an A to Z business. And what I mean by A to Z is, at Aurora, we owned everything. We owned the marketing, we owned the software, we owned the processes, we owned absolutely everything. We owned all the clients, right? So everything was centrally owned, and that was by design. So I wouldn't change too much, but more on the KiwiSaver focus.
There's a lot of books, and I've heard this story time and time again where they go, oh, I'm buying it, but all the data's in like spreadsheets. The clients don't get service because the advisor can't be bothered doing refixes. And for a lot of people, that's the reality, because 85, 90% of businesses in the industry are 1 to 5 advisor companies. So that does scream, lifestyle rather than like trying to grow.
Oh, most advisors are lifestyle advisors. Yeah. And I think, and that's what I thought the new legislation was going to get rid of, some of the lifestyle advisors. It seems like they're still hanging on, which is fair enough. And, more advisors, I guess, is a good thing. But, I mean, for me, I don't know, like, if you really want to drive that value to your business, you've just got to make that distinguishing at the start. Am I a business? Am I a book? And then making sure, because, I got asked the other day, is my business worth more if I've got admin staff? Well, no, if you're selling your book, it's probably, they've probably got their own admin staff. They probably don't need you. But if you are selling the business and a new owner's coming in and that admin staff are, pivotal to delivering the service to your business and your clients, and it's done in a profitable way, then yes, it's absolutely going to add value. So there's quite a few levers that can be pulled or to, change the outcome of that.
Yes, the answer is always, it depends.
Oh, man, there's so many things it can depend on.
And a lot of advisors, though, even though they've got a brand set up, it is still ultimately on them. Were you ever giving advice? Did you ever have to step back from that? Were you always sitting from?
No, I can't think of anything worse than being an advisor. Sorry, no offense. So no, for me, that wasn't what I was in this game to do. From day one, it was starting, scaling, and exiting. From day one, I knew who we were going to sell to, why we were going to sell to them, why they were going to pay a multiple, what they were going to do. Obviously, that hypothetical buyer, obviously at the end, but. So for me, I didn't want to be an advisor and try and, do that. I mean, I understand financial advising, it's not that difficult, but to do it well, yeah, sure, it's you've got to learn, but I was never the advisor in the room.
And you've got a goal of getting a stretch goal, from what I've heard, of 40 mil by 40.
Yeah. I said that as a throwaway comment. Yeah.
Isn't it funny, the things that come back?
So let's set the record straight on that. And if you listen to the whole clip, it's because the podcast was called 10 million in 10 years. And so I just jokingly, because I'm 37, I said, I don't know what else rhymes. So I said 40 by 40.
Love it.
And the guy connected to it. He's like, this is it. This is great. And I was like, just to be clear, this is not a goal. It's not getting me out of bed. I don't think it's going to happen. And and if anything, it actually probably put me in a bad mindset. Like I suddenly had this, like, should I not be happy if I have $35 million net worth? You know, or 25 or 15 or like, and I was like, man, this is ridiculous. I actually wish I hadn't said that.
I'm glad we set the record straight.
Yeah, record straight. No plan to be 40 by 40. Yeah.
Title of the episode.
I plan to
37 by 37.
Yeah. Yeah. But we'll see. It could happen. Yeah.
Yeah, and so now I'm keen to find out about your new venture in terms of your funding advisor books and book purchases.
Yeah, so I'll tell you kind of the genesis of the story. So I exited 3 companies in the space of 18 months. And after all the exits, I kind of was like, my plan was to set up my family office and kind of lean more into the venture capital private equity space. And one of the opportunities that came across my desk soon after exiting was a financial advice business based in the South Island. They said, hey, Si, this really good book's just come on the market. It's paying $500,000 a year plus in trail. I'd love to buy it, but tapped on my, property portfolio, and my wife wants us to buy a bigger house. So no love from the banks from buying it. And I looked at it and I went, well, I understand the risk and the credit, the credit risk of this book. I understand, where the security lies. I understand where the asset value lies. I know the liquidity of these products. And I went, well, mate, I'll fund it. So I funded a book purchase, and it was really good. And worked really well for the advisor, worked really well for me. And, essentially on the first of every month, I got paid a whole bunch of money and didn't have to do anything for it. The payment rolls in. There's no, I'm just trying to like compare it to say commercial or residential real estate, like tenants, like there's no windows to fix, there's no bathroom to fix, there's no council rates, there's no insurance.
Annoying tenants.
There's no annoying tenants. There's no lovely property managers who I deal with. I love my property manager. But it just rolled in every month. And I'm going, well, is there an opportunity here to do this on a more industrial scale? So not just doing it off my own personal balance sheet, but potentially acquiring a small private credit fund or a small, business-to-business finance company. And sometimes, things just align. And a good friend of mine, Nigel Thompson, just said, hey, so I'm 60 next year. Do you want to buy my finance company? And I said, well, I have this product that I'm already doing in my own capacity. It's called client-based funding. Basically, I fund financial advisors to help grow their business by acquiring other businesses and books. And Nigel looks at me and goes, that's a really, really good idea. And I'm like, okay, well, that's a good start. So much so that he was like, maybe I should just stay in this business, let you buy most of it, and then just stay in it for a little bit and see where this goes. And in the end, he said, no, this is your thing, your gig. Buy me out and take it forward. And so, so I acquired the company. So now we've got a much bigger pool of money. We've officially created the product called client-based funding, and now we're out there meeting with advisors who are looking to grow their business, improve the enterprise value of that business, and kind of compete with the bigger firms. Because the bigger firms, they can buy books. They've got that money. They've got the cash flow. They've got the balance sheet. Where a lot of advisors, that 1 to 5 man band we were talking about earlier, they might make 200, 300, 400K a year. But after tax costs, it's not lots left over. And then they've, 80% LVR on their family home. Maybe they've bought their first investment or second investment property and they're 100% LVR, ticked up on those. So when a really good opportunity to take their business from this level to this level comes up, they just don't have the legs to do it. But the problem is that, well, that book or business that they're buying, that's a really good asset. And the operator down here is a very good operator. So what client-based funding is designed to do is to close that gap and say, you know what? Yes, the banks won't fund you on this, but we will. So what we do is we don't take property as a security. Our goal is that we just take your current book of clients, and if you've got 100K worth of trail or 200K worth of trail, and you want to buy another 100 or 2 or 3 or 400, what we can do is combine that together and sort of unlock the equity in your asset. to help you acquire that next book, bring it onto your business, bring it onto your financials, and then either help you grow more or eventually get you back to a main bank, depending on how hungry for growth you are.
Because you must have had a point when you were growing Aurora and you're going, the bigger I grow this, the fewer buyers there are going to potentially be out there.
Totally.
And then, you're tangling with a few and you kind of like would have earmarked like who these people are.
Totally.
Do you think this would open the door to maybe some of those other players who couldn't even consider you previously?
Interesting. I think in that space, money's not a problem where Aurora was selling, because you're dealing with private equity funds or big players. But I think in that kind of $1 to $5 million check size, this will start to open up people who, going, I'm a $500,000 business. Can I become a $1 to $5 million through acquisition? Therefore, you would become a $1 to $5 million business, right? And that would then be a pretty good target for some of that larger size investment advisor firms to buy. So I don't know if that really answers the question, but I mean, it's definitely going to enable people who are thinking, how do I grow my business, right? And the 3 ways you can grow a financial advice firm. One is, you can organically grow it through referrals and giveaways and promotions and showing up to baby shows and stuff like that and getting leads. The other option is you can actually, you can buy leads, right? You can go and buy online leads, or you can buy, direct marketed leads and try and upsell them. That's quite tricky. A lot of financial advisors can't do that. And the first option, which was with the organic, it's slow. It takes ages, right? It takes years and years and years of grinding to hopefully one day have an okay payoff. But the third option is acquisition, right? Growth through acquisition is a legitimate strategy. It's one that's been done by a few of the big advice firms extremely well. I'm thinking guys like Andrew Hay from Apex, right? That guy has just grown by writing checks, and he's done it really, really well. So he's now in a position, or people like him, where they can just write checks and keep buying. But how do you go from being kind of that one-man band, three-man band, to being someone like that? And that's what this product's designed to do. It's to give you more financial muscle that you can flex in terms of purchasing and growing those businesses. So that's why we kind of put the product together, and that's sort of the I don't know what to say, person, the advisor, the company that we're looking to back, is to find people who are in that space wanting to grow but just don't know how.
And the key part for a lot of those businesses is they're like, I really want to buy. I know I need this is like my strategy. Put me in touch with people who want to sell. But the hard part is, like, a lot of the time when people come to me, I find out the last moment because they go, hey, this is happening.
100%.
What's the next step?
Totally.
And a lot of the time when I chat to those advisors, it's not, we all met up at a cafe and, it was like an auction type process. A lot of the time they just know and have worked the long game with that advisor or that advice business. They've done the networking.
Totally. And that's, I mean, I'm looking at it from our angle of being the funder, right? That's our biggest challenge, is how do we actually get our buyers front of line or in front of potential sellers, and closing that gap is there's Advice Bridge, that's probably the established player in the market. You got By the Book, who's coming out now, which are doing their own way, and I think there is there is a probably room in that space to grow some sort of way of connecting buyers and sellers in a discreet way, but where you can still run a market process and get a good value for your book or your business. So that's one of the things that we're trying to do at FIFO, is actually almost do that networking on behalf of our buyers, right? It's getting to know people who are thinking about selling, thinking about exiting, and maybe, we're giving them some pointers on how you can maximize that value, but then going, well, we've helped you along this journey. Great, we can make a non-binding indicative offer on behalf of our client, and therefore if you're comfortable with the terms, you're comfortable with the price, boom, FIFO client, here you go, we fund it and move on. So that's a developing process, and we're keen, and like you're right, it's often by the time you've heard about it, it's too late, and normally the ones you've heard about are not the ones you want to buy. That's the other kind of thing that you've got to be careful when doing due diligence on a book or a business. So it's not easy, but it's possible. That's the main thing.
It's very difficult. And also, when it's at the open market, if it is an attractive book, you naturally, as the buyer, going to have to pay a higher multiple.
Yeah. So I talk to people about this, right? And growing up, right, went to Avondale College. I worked at Caltex. I was a courier driver, right? Like, so no, I wasn't rich or anything, and I was a lot more, I have to, like, every deal I do has to be the best. And I've got to win that deal and I've got to get that for the best price and all that. And, that's done me well. But the older I get and probably the more successful I get, the more I'm actually like, well, if I have to pay a premium for this, the real question to me is, what is that business or book in my hands worth in the future? And I'll even use FIFO as an example, right? I'm pretty vocal that I paid overs for it, right? But I paid overs because I knew in my hands it's going to have a lot of upside potential. But what I'm buying is super solid, great handover, good reputation. So I don't mind giving a premium. If I had to really grind down the price of that to what, I probably valued it at, well, I probably wouldn't own it right now. So for me, it's, when you're acquiring assets, acquiring business, it's, you can go, what's it worth and can I get it at a discount? Okay, that's a valid strategy. Or you can go, what's it worth and I pay that if that's possible. But if you have to pay overs, well, personally, if it's a solid business, solid book, and in your hands is going to be worth a lot more, then back yourself.
There's a lot of businesses like that where you'd say the market rate is, X, but in the right hands, somebody could crush it and make that, 2, 4, 5X what it currently is worth.
Yeah. And that's what I'm more interested in, is going, can we fund you into something that in your hands is worth a lot more money? Have you already got the infrastructure in terms of, you're on the right software program, you've got a really good systems and processes in your business that, service clients effectively and services them, economically, then just plugging in this to your business is actually going to go predominantly to the bottom line, right? There's a lot of ways that you could structure your business and structure the one that you're buying into it that day one, you're doing pretty good.
There's still a lot out there that systems and processes are not set up in a way that there's no way you could plug in another,
Can we be real about this? Can we be real about this for a second?
Let's get real.
I roll my eyes when an advisor tells me, like, what are you doing all day? I'm working on my systems and processes. I'm like, for what? You literally, you see a client, you give them a statement of advice, you fill out an application form, you send that to someone, they go, yeah, good to go. Your CRM handles all of it. What systems and processes are taking you hours and hours a week to build? It just blows my mind, the inefficiency and the absolute waste of time of people when they say that.
Some people just don't use it. So it's like that same, like the busiest people, like
have more time.
Why are they busy? But then you chat to some others, like I can see the numbers, and some advisors who I chat to are like crushing it. And, whenever you call them, they pick up.
Yeah.
They've always got time. Yeah, let's catch up. And then others who I know maybe not writing as much, maybe they've got other things in their personal life, but for some reason they seem busy.
Yeah.
And I'm sure if you looked at like the usage of Trail or whatever CRM platform they're using, like chances are they're not using it how it's designed.
No, and a lot of people don't know how to structure their week, right? But I used to say that to our guys, right? I'd always say, hands up, who did 40 hours last week? And, everyone's hands up. All right, well, who did more than, 10 appointments? Oh, half the hands go down. And you're like, okay, so you, and I'd pick on someone and I'd say, oh, so how many appointments did you do? Oh, 6. Okay, well, how long's your average appointment? Oh, an hour, Okay, so you did 6 hours, 6 or 7 hours of client-facing work? Cool. So what did you do for the other 30 plus hours of your work week? Oh. I'm like, so you didn't even work 10 hours, you had your hand up saying I worked 40 hours. So there's a huge lack of efficiency. And this is actually a New Zealand problem, right? Like people go, oh, our GDP is so low. Well, our GDP is low because our dollar sucks and because we're not as efficient as we think we are. The top 5% of workers in a business get 90% of the work done. And that's just the reality of it, and it's the same. You probably can see the numbers of people in your system, right? The 5% are just getting all the volume and the other 90% are working on systems and processes instead of just doing what they're meant to be doing. So, that grinds my gears.
Well, it's that whole balance. I think if you look at like what are the things that are going to drive, what are the strategic things that advisors can be working on that can drive profitability? And it would be, sales, so outbound, could be marketing, research and development. that should be the majority of the time spent doing those three things, where a lot of the stuff that people work on is
What sort of research and development would there, we're just thinking financial advice firms here.
Yeah,
right?
yeah. So it could be like, should I be adding another should I be adding KiwiSaver as a,
Okay, that's what you mean by
it's broad, but
yeah.
what are some other things I can be doing to add value to the business? What can I bring in some different revenue streams? Where a lot of them spend a lot of time administrative work, refining processes.
Yeah.
When really, like, a lot of the processes out there are like, it's a 6-step process. It's even set by the legislation. So following that and using the tools that you've got, if you're with Trail or whatever CRM system you're in New Zealand, you should have a framework which is there.
Well, I mean, every good CRM system follows the 6-step process anyway. So, like, you can't not do it if you're following your system that's already been built, right? And I mean, that's one thing our software was really good at, was just you click, 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 click. You just go through a 6-step process naturally. Like, there was no way to not do it by design, obviously. But
and I'm sure if those advisors were doing a time audit, like, how many would fill up at least half their time with those three strategic parts? The rest of it is kept busy doing other little things in the company.
Busy being busy.
Yeah, God, I feel for that advisor getting called out in front of the team. Yeah, because it's just
it was a well-known thing. Yeah, I'd always make sure it was someone who could handle it. Like, I wouldn't pick on someone who didn't have thick skin, but yeah, there was definitely a couple who I'd quite happily tell me about what you're doing.
Because there's some weeks, and I'd be in that same position. You're going, I know I was like a blue-ass fly running around, but in reality, did I spend that time adding to the bottom line, or was it just doing whatever? Yeah, just chatting on a podcast.
Like if you took a stopwatch and like worked out how much time you're actually working, oh mate, most people would be quite surprised. And answering an email, which isn't really important, and you're taking 40 minutes to do that, it's not really
crafting the perfect email.
Yeah.
And I've spoken to advisors in the past, and they've talked about like the best advisors and why some loan writers that they promote into that role like never really shoot the lights out as an advisor, because it's like a lot of the time spent just like meticulously like designing like the notes and this, when a lot of the time like the end clients, when they get the document or like they have the advice with you, I think a large majority of clients are like, say less. I trust, they need to understand. So I get that you got a compliance obligation, but less is more.
Yeah, I mean, at the end of the day as well, I was always of the believer that the advisor is the one giving the advice. So I didn't, you meet some advisors and they're essentially just asking their client, oh, what would you like? And how much life insurance and how much trauma and how much this? And I'm like, hang on, like when a plumber comes around to my house, I'm not asking, and how are you going to fix this and how do you do that? Or telling them this is how you unclog my toilet, right? Like that's not my skill. So for me, the advisor should be going, well, I've understood your situation. I know the market. I know the products, and I've brought you this that fits you like a glove. Yes, you've got to understand it, and they get why it's there and why it's important. Great. It's my responsibility, my fiduciary responsibility to my client is to make sure that is perfect for them, and they go, great.
Let's do it.
Let's do it. Yeah.
Now you had a young team of advisors, and that is always something that people weigh up. We've spoken just before about, the balance between, do you pay commission or do you do salary? Yeah. Like I've said before, and I've written an article about it, like salary is the better option for advice businesses, but it does suck up a little bit of that cash flow.
A little.
Just a little bit.
Well, I mean, I'll just tell you, when we moved from a commission to salary, like so much positive things changed in our even just with the same group of people, just giving them that security that a salary brings. We used to say that like two main things is to think about, right? Well, one was when people are on commission, they make money 9-10 months a year, right? And make nothing generally 2 months a year, right? And that's normally January. Sometimes there's a little bit of April and a little bit of December. That's kind of their 2-month block where they're not really making any money. The problem is they make no money for the month. They've dried up their pipeline. They've forgotten how much money they've made over the last 10 months. They've got bills as if they're earning whatever their best month was times by 12, not whatever their worst month is times by 12. Yep. And then they panic. They really do. They get themselves into these, and they don't put aside their GST. They don't put aside their tax. And, they've got no idea how to run being a self-employed person in the background. So what happens is you get all these advisors who 10 months of the year, they're great. But then they go and do something else because they go, you know what? oh yeah, I did it. I made 100+ grand the first year. But the reality is the next year they didn't, because they just didn't manage their time. They didn't manage their finances, and it became too much. So one, what we realize is we can make money off them 10 months a year and lose money off them 10 months a year. But our advisor comes back the next year and gets better and better and better. And so we don't, because the cost of onboarding a new advisor, training them, doing all that. I mean, it's an expensive process, right? So if you're doing that and they just leave because they have a couple of bad months, then it's just this cycle of just attrition, and that's just grinding, right? Where at least if they're on salary, you go, okay, we didn't make any money off you in January or, a bit of December, but February, March, April, May, we did. And, oh, hang on, you're back next January, February. We don't have to go through that cost of bringing on and training and stuff. So then suddenly you go, oh, I used to have 10 and now I have 20, now I have 30, now I have 40, now I have 50, 60, 70, 80, 90 advisors, right? And that builds, where commission, that was never going to happen. And the other thing, that mental shift from commission to salary. So 9 out of 10 policies we used to write as a commission-based business were good. Good clients, loved what we were doing, long-term, perfect. But 1 out of 10, that was the one that the advisor knew in their heart, this isn't going to last forever. Or, the wife said something that made me, hang on, is this are they moving to Australia in 6 months? Are they almost, something changing in their scenario where this product might not be relevant for them? But because that 1 out of 10 is that month that's going to be a 0, or is that, week where they didn't get anything in, and, mortgages due next week, rent's due next week, that they push it in and hope that it's going to be okay. But it never is. So then you've got 10% of your book that falls off, that should have never have been on there. But the 90% left over are good. But 90% will always, a little bit will change over time. So you're kind of going, oh crap, now we're at like 85% persistency. That's not good. It's not profitable. Can't sell that for lots of money. So when we moved to salary, that 1 out of 10 policy that they knew shouldn't come on the books, you knew, I knew, just stopped showing up. So our persistency levels just went through the roof. They just got better and better and better and better. And so the word clawback became a thing of the past. We didn't have to worry about it. It was just such an irrelevant part of our business. And our persistency levels were great. Our clients were happy. And it was just from going, you know what? We'll support you on the 1 or 2 months that aren't going so good, but you're going to support us on the other 10 months when things are good. And it builds a better culture, a better level of advisor, and a better outcome for clients. So I would never start a commission-based financial advice firm.
And it takes a couple of years before you start like really getting the profitability from the advisors working in the company too.
Yeah. I mean, so, and the funny thing was, right, is that people always thought that our advisors weren't paid well. And it was just a complete misunderstanding of what we did, complete misunderstanding of the actual package that our advisors got. And the reality was, and it's funny, I won't say by names, but a friend of mine's looking at his key staff buying into his business now, right? And he asked me, he said, at Aurora, when your key staff bought in, like, how did that go down? And I said, well, they all wrote me a check. They, hey, well, not an actual check, but like they physically transferred a shitload of money from their back pocket to my back pocket, right? That was part of the trying to get them mentally shift from I'm a employee to I'm an owner. And he said, but how did they afford it? Oh, mate, they all had money. They all had the cash sitting there. Like, we had a culture of you live off your salary, you save and invest your bonus. So it didn't take too many, 2 or 3 years and, I got 100 grand, I can put into that. No problem. Great. Where his guys are all commission and on the high rates of commission, they've got nothing.
And how did you structure that balance for bonuses?
Yeah.
Where, it's like, obviously there needs to be like a revenue aspect, but also compliance, and there's, with the legislation around COFI, there's like a new lens for that.
Yeah, so I'm lucky that that new stuff has come since I've been out of the game. So I don't have a really up-to-date model of exactly how you do it, but my understanding is it hasn't changed too much. But essentially, you've got to make sure that the period between bonus periods is long enough that you can have good months and bad months. You can have any bad business or good business show up, and you can take that into account. Obviously, you've got to have, we used to call it the good client bonus, or it's a good, we had a name for it, and that's where your quarterly compliance report would have, things in there. Did you have, stuff missing on SOAs? Did you have not get a 5 out of 5 client feedback? Did you not, and then that would potentially lower your bonus a little bit as well. But we ran a good ship, so for us, that really wasn't an issue. And again, there's things that you can do to create good behaviors for your advisors, right? And so one of the things that we did that, again, huge shift in the right direction was we had someone in the business call every single client before that they became a client who had no incentive, no bonus, no salary increase, no nothing to whether or not that client came on board. And just the fact that the advisors knew that a neutral person from our head office is going to be calling the clients to make sure that they understood everything, they disclosed everything, they realized that this is a commitment, blah, 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 right? That no piece of business would get onto our book until they'd gone through that call. It just meant that they just stopped trying it on. They just stopped sending bad business to you because they know it's not going to, if it doesn't get past the verification call, guess what? You're not getting paid. It's not going to your bonus. Don't worry. You're still on salary. So you're not going to, you can still pay your rent next week, but you're not going to be driving your career ahead. You're not going to be hitting those bonuses. And you're not going to be hitting your other goals and targets that you have for yourself. So there's just lots of things that you can do as a business owner to incentivize the right behaviors, to incentivize the right outcomes. But it is a balancing act. And, every year the business would go through a different iteration. We'd always say 1.0, 2.0, 3.0, 4.0, and then we sold at 5.0. So, yeah.
And then how did you structure it for those? I mean, first things first, how did you know an employee was the right person to then bring into the inner sanctum? And then how would you structure the payment for that? Would it be at a rate that was fair market, or would it be something that, was fair for recognizing the value that they brought to the business?
Yeah, good question. So just for clarity, what we're talking about is we're talking about key staff who are now buying into becoming shareholders and owners in the business. So what the good thing was if you were at that stage where we were talking about ownership, you weren't new. You'd been here for more than 2 or 3 years, probably longer in most cases. We'd seen what value you brought to the business. We'd understand where you can kind of fit in. So the try before you buy, we'd already been trying, right? So there was that wasn't, in question. The second part of your question was, how did we make sure that there was a fair value? Yeah. So what we did is we always said, hey, we're an A to Z business, and this is how we believe that we would be valued on the open market, right? And based off the open market, we think, and I'll just make up round numbers, we're worth $1 million, right? But what we would do is, and that was based off a certain multiple of EBITDA, we lowered that to a lower multiple of EBITDA. And what we did for the first 2 rounds of shareholders coming on is that we took the last 12 months results. So actually you're buying in when we were valued at $500,000. You can see on today where it's already $1 million, but we'll give you kind of a 12 months. So what it was 12 months ago. So on paper, our guys go, cool, I've just bought $100,000 worth of shares. On paper, they're already worth $160,000.
Win-win.
Win-win, yep. And so we'd always have our shareholder meetings every year, and every year it's here's where we're valued now, here's what we're doing to push that valuation up. And we were pretty transparent about where our valuation was because people would continue to buy in as that value, went up. So some people bought in low, some people bought in a little bit higher. And, I think it was 7 or 8. So what the valuation I sold out for was 7.5, 8 times what the first guys bought in. So if you'd bought $100,000 worth of shares, you've now got, 700,000 or 800,000 K worth of, equity in the business, and that's only growing. So, that's a win. And the other thing to think about as well was New Zealand has this, and not just in financial services, New Zealand has this problem where we promote above competency. Do you know what I mean? Often you get someone who's really good at their job, so we promote them up, often from a operational role to a management role. And the problem is they were really good at this role, not so good at this role, and people don't do U-turns. People don't go, oh, hey, actually, can I go back to the role I used to be in? And you know what? Just cut the salary back down. That's fine. So what happens then is they go into roles where they're not competent. It annoys the people below them. It annoys them because they're not good at their job anymore, and they get frustrated and they leave, right? So suddenly you've got who was a really good operator is now out the door and somewhere else, right? So what we didn't want to do is create a business model, because we'd seen this happen before, where you had to be good at selling to become a good sales manager. You had to be a good sales manager to become a business owner. The reality is those three skill sets aren't overlapping very often, right? Often your best advisors have no patience, no time, no care for the new advisor that they're meant to be mentoring and training, right? Where it's often the next level down of advisor who actually is, oh, I'm happy to stay here for an hour and train you on your calls. I'm happy to go along with you. Where your top advisor's like, mate, I could be, out there bringing on clients like this, making myself a lot more money. Why do I want to do this? And then it was the same about sales managers. Sales managers aren't necessarily good business owners, right? And so what we wanted to do is have a business where you didn't just have to be the top sales manager to be able to buy into the business. So we made the opportunity of buying into our business, our head of compliance, our head of advice, yes, some of the sales managers, but we didn't want to have just a one route to ownership. We wanted to have across the board where people could be owners and not just, a one-trick pony.
That is a problem in a lot of service-based industries where you have people good at sales and they just naturally they go there. And like you said, the ego, I'm not going back.
No.
Am I going to take a pay cut?
No.
Hell no.
Yeah. And it's actually, everyone loses. Everyone loses. No one wins in that scenario. So that was one thing I really wanted to actively get better at, was not promoting people into roles they weren't good at. So even if we had to kind of create a new career path, so you could still go up, still get pay rises, still feel like your, career development is probably the number one driver of, people working hard in the business, but not going, hey, Warwick, you're really good sales, and now you're over here because that's the obvious up. It's like, well, actually, you're the kind of guy that we should just be putting a better network around you, or better systems around you, or giving you more flexibility, so or more resources, or double your leads, or whatever it is, so you actually just keep going up, but what you're actually good at, and not just, going, hey, you're over here now because that's the next step.
And hiring young people into the industry, I think it's something that we're doing poorly.
Yeah.
I'm seeing more come in, but it's really challenging because there's a lot of companies, they are commission-based, or they don't have the capital currently to pay a salary to bring people in.
Yep.
And it's quite hard,
It's very hard.
If you don't have the leads coming in.
It's very hard. Yeah.
How did you structure your training so that those new advisors came in and they were like clued up on the industry without taking, 6 months to get them onboarded?
So a big mistake we made at the start of our career, start of my ownership career, was I used the gang analogy, right? The best gangs, they recruit brains and train muscle, rather than recruit muscle and try and make their muscly guys smart. Doesn't work. So in the financial advice, and you look at like the top gangs, they're all smart guys. They're not the big guys. And we kind of use that same philosophy with us. So initially, we hired all these sales guys, great talkers, super charismatic, like the kind of guys that I just don't like hanging out with. But anyhow, because they were confident ringing people, they were confident in front of clients. But what we found was that, especially in the insurance game, it's not a one-night stand. It's a long-term relationship, right? You actually need people who are trying to build a long-term relationship with that client, and at least on behalf of the firm. So what we found was actually easier to recruit, let's call them smarter people, or, maybe more analytical people, and coach and train them on the sales and communication, rather than take someone who was pretty good at the sales and communication and trying to make them smarter and understand these products. Because if you couldn't easily understand why in your client's shoes that this product was perfect for them, right? If you couldn't understand that in a true, like, this is why this product was designed, this is why it's there, and this is why this client's going to take it, and this is why the client's going to keep it. If you didn't really get that, if that didn't sink in, I can't make you smarter, right? But the smart guys would go, okay, I might not be the best on the phone to start with, but they could follow a process. They could learn the process, and then they were smart enough to go, oh, that's why Simon says we say that, and then that, and then this, and then that, and then this. And then the client's going, yeah, it sounds good. So that's where we made a real big shift. So and that leads into your training, right? So who's coming in? It's It's got to be someone. And I used to actually call it the CEO test, right? If I put this advisor in front of Naomi Ballantyne, is she going to say, wow, Simon, you've got some great people in your organization? Or is she going to go, who is this guy? And that's the reality. And we used to get a lot of praise for that. A lot of praise. We'd get people from across the industry coming and going, I love that, these people with all these good, hearty names, and we're like, yeah, that's just who we are. So we made sure we got good people. Would they pass the CEO test? And again, don't have to be that salesy. The salesy stuff is actually a lot easier to train to someone than brains, So start with someone smart. Then you've also got to look for people who, like I said, I went to Avondale College, right? My brother's a policeman. My oldest brother is unemployed, right? Where, we haven't got any silver spoon in our mouths. We need to go to work. We need to pay for our own stuff. You need to find people who have to have a reason to go to work, right? Because, the reality is selling financial products, whether it be KiwiSaver, mortgages, insurance, it's tough. It's some rejection. It's often after hours. It's, it's not as cool as it sounds when you're recruiting someone. You go, hey, come in, you'll be a financial advisor. Woo, life's good. The reality is, calling through leads going, oh, hi, sorry. You're speaking with a member of my marketing team 3 months ago about having a chat around. Hello? Oh, crap. Okay. Take that lead off the list over and over and over again, right? So you've got to have someone who has a drive to get them and their family or, their lifestyle to that next level. If they don't have that, it's very hard to motivate someone over and over and over and over again. You can pick them up on a bad week, but you can't be every week trying to motivate them just to do their job. So smart doesn't come from necessarily extreme wealth. Kind of middle class is great. And then getting them in front of people.
And then what does the ramp look like in terms of someone joining you until the point where they're, speaking in front of a customer, giving financial advice?
Yeah, in the good old days, pretty quick. Well, obviously now, and this has actually been a really good thing about legislation, right? Is the level 5. What a great little fence people have to jump over. It's not hard. It's easy. And if you can't get through that easily, you have no chance of having a long-term career in financial services, right? So that was something that was really good. So that's made it a lot easier. Before you had to have your level 5. I guess, I come from kind of, you should throw people in the deep end. You should get them on the phone straight away. You should get them with a sales manager in front of people straight away. What we generally found, right, is either you're selling at a level where you're going to be profitable within 90 days or you're never going to get there. If someone in their first 90 days, if it just hasn't clicked and they've gone, you know what, I'm actually comfortable sitting in front of these people. You know what, I'm actually comfortable saying, hey, what was the reason you're at the doctor's last week? Okay, cool. And guys, we're going to give you $1 million here, $500,000 there, and we're putting you in the growth fund for your KiwiSaver. Sound good? Yeah, great, cool. Let's do the paperwork, right? If you can't do that, then this isn't going to work. So unfortunately, we had a Labor government at the time, so if you had more than 20 employees, you weren't allowed to do the 90-day trial. Thankfully, we've got not a Labor government at the moment, so you can still bring people on and do that 90-day trial, because I think I can count on my hand the amount of advisors that weren't good in their first 90 days. And by good, I mean just at a level where it's sustainable and they will eventually be profitable within 90 days. I can count on my hand how many people would have been crap at the start and finally got themselves into a level. Either it clicks or it doesn't. CEO test, recruit brains, train sales, get them in front of clients quickly. KiwiSaver is a great place to start. Then as they get more confident, get them into insurance. Then if they're a bit more analytical, get them into mortgages. Most people can't do both. I can count on my hand again, people who can sell mortgages at a high level and insurance. I don't know why. The brain's either wired one way or the other. Insurance and KiwiSaver, they're a lot closer. It's kind of the KiwiSaver is, would you like fries with that? So that's those products seem to be better sold together. And mortgage advisors they're princesses, all of them. They are all like, don't give me a lead unless it's ready. $2 million refinance, 50% LVR with surgeons on great salaries. Otherwise, I don't want to talk to the client, right? Where your younger advisors in the KiwiSaver insurance space are a bit happy to roll up the sleeves and get to work.
whatever works.
Yeah.
Yeah. And I was talking to an advisor last week, and they were saying how, that they've run a marketing campaign. They go, like 10% might be that, dink, double income, no kids, and, they're earning really well and no debt and sweet as. 80%, 10 you're just not even going to deal with. And then 80%, there's that grey area. They might have like a bit of a credit history or maybe some debt, or, things aren't going as swimmingly as the other top 10%.
Or as well as they said, when you're filling out the statement of position, you're like, oh, this is straight through. And then you get the bank accounts and everything. There's a mismatch here. Yeah, that happens a lot. But no, so if you're building a financial advice firm, there's a lot to think about. But again, it's just start with that. Hey, am I building a book or am I building a business? And then next thing down is, am I doing this for an exit? So I'm foregoing short-term profits and short-term easiness for a long-term. Like I always said to my guys, I get paid last, right? I always get paid last, and I'll get paid when this is sold. That's when I earn my money, right? But other people, they don't want to do that. They might be, hey, I just want a lifestyle business, and that's fine. But if you are someone who is going to, try and grow a business, then you've got to get that structure right. You've got to make sure that your strategy is in line with growing enterprise value, not with growing a lifestyle or a owner-operated business, because they're two different things, and you can't mix.
And either's fine, just depends on their goals.
Yeah. I actually find it refreshing when people are like, you know what? Like I run my own little thing. It's great. I can surf. I can do this. I help some clients out. That sounds great. Like why am I working so much for so little pay? I totally, but people just got to be honest with themselves. And when I meet someone and they're socially awkward and they go, I want to bring on a team, I'm like, how? Like you don't have the skills. You don't have the sales skills. You don't have the people skills. You don't have the management skills. Good luck. It's a real key thing for growing a team is, every person is different. There's no manual that says, here's how you grow a team. Warwick's motivated by A and B. Simon's motivated by C and D. And the next person, Ben's, motivated by nothing. But somehow you got to get them all on the same team, pointing the same way. So that's the challenge.
Man, there's been some really, really good insights here. The part about setting it up and having that exit planned before you even get the ball rolling is such a critical one that I think a lot will take value from. I think how to build that A to Z business is really crucial. Hiring and bringing on staff, that part, I think it's really in depth and people get value from that.
Yeah.
I wanted to wrap up with a few like overrated versus underrated. I'm gonna run through a few here. Let me know what you think. Vendor finance, overrated or underrated?
In the right scenarios, it's underrated, but be careful. Because often vendor finance it's actually telling you something that, they're not as confident in the product that they're selling as they might think. So I will say it's underrated if you can do it right.
Key advisor staying in the business post-sale.
So can I only say overrated or underrated?
Yeah.
Yeah, okay. So I can't
You're going to say it depends to everything, aren't you?
I always say if the key advisor wasn't the owner, then it's great. Completely underrated, you should do that, right? Because then you've got some continuity, whatever. But I always say, especially if the owner, you don't want your ex-girlfriend staying in your house, right, once you're broken up. So, it's time to move out. So actually, often it's having the old owner or whatever is not good. But a key staff member, definitely underrated. You want them there.
Yeah. Advice, business, brand.
Oh, yeah. If you want to sell for a high enterprise value, you need to build a brand, not a Simon Rolland financial. Yes, there's a couple of examples of that works, Mike Pero, all that. And actually Mike Pero did the best because he then kept himself on retainers to show up and just be the face of it and have nothing to do with it. But most people, unless you've got a nice catchy sounding name.
God, that jingle.
Yeah.
Ingrained in my brain.
Mike Pero. Yeah. So I think brand is underrated. Calling it Simon Rolland Financial is boring, and people are always going to want to talk to you. And therefore, when you sell the business, they're going to go, where's Simon?
I wonder if there's like some type of algorithm where like the cooler your name sounds.
Totally. Yeah.
Like Mike Pero rolls off the tongue.
It does. Yeah. But Simon Rolland doesn't.
Warwick Slow, yeah. You could -2 multiple.
Yeah, exactly. Yeah.
Last one is in-house marketing. versus outsourced?
Yeah, good question. I'm going to say underrated, but the caveat to that is that you understand marketing and you know how to do that. It's a skill set, right? So we owned our marketing, we owned all of it. But we were very, very lucky that we got some really good marketing managers in soon. We're very, very lucky that we understood what it took to generate high quality leads. That skill set's rare and hard to find. So if you have it, absolutely in-house it. Makes sense, right? If you don't and you recognize, you know what, I don't have the skill set for generating good leads, then just outsource it. Yeah. But the key to leads, can I just, give a little bit on this? The key to leads is knowing when to call, what to say, and how to completely understand how you win that phone call for booking the appointment, right? If you ring up, and this is why most advisors can't buy leads long term, ring up and go, yeah, g'day, is that Warwick? Hi, this is Simon from Simon Rolland Financial. Yes, I was inquiring as you wanted some help with your insurances and, your mortgage. Well, people go, no, thanks, sorry, right? And if you don't understand why Warwick isn't booking in and his wife's going to be there and they're ready to meet you tomorrow at 7 p.m., then don't buy leads. Buy training around it or pay for a professional sitter, like a call sitter or whatever they're called. Because otherwise you're gonna get 10 leads and you might get lucky that one says, yep, come around and yep, sign you up, but you're not going to build a business based off that. You need to know if you got 10 leads, you're talking to 6 or 7 people, you're booking in 5, you're meeting 4, you're doing presentations to 3, and you're signing up 1 or 2 each week.
Would that be a typical conversion rate that you guys had?
Yeah.
There's actually a lot of advisors I chat to, they'll be like 1 in 10 will even, get into the appointment. Some don't even pick up.
I worked at AMP for a while, and we'd have these boomer advisors that would just show up at 8 a.m. in the morning and start calling through leads, like calling through our own clients. And they'd have like a 1 in 20 book in, right? So they're calling for hours just to get one appointment, right? I would show up on a Tuesday at like 2 o'clock in the afternoon, make a couple of calls, and like I was taking the piss when I was working at AMP. I'll put that out there. I really wasn't. Once I realized this wasn't my future, I was kind of like, I'll just, whatever. But
appreciate your honesty there.
Yeah, I can say that now. I'm out of, the long time gone. But, and then my boss said, here's month prize for the most active advisor, Simon Rolland. And he started to give me a Prezi card or something. And I was like, well, this is a stitch up. Am I getting fired or something? Because I'm just doing nothing. And then he's like, oh, no, you had the most meetings last week. And I was like, you've got to be kidding me. Like I was hanging out at my mate's work, doing other things. So the point of the story is learn how to make a call. And if you don't know how to make a call, ask someone who does, because your life will change.
So how would you coach someone to make a call?
Well, that was one of our secret sauce, right? I was very lucky when I started in the industry. I got flown to America a couple times a year to go on like sales training and sales management training. And I did a 101, 201, 301, 401 course in the States. And what I worked out early was, some people are really good at selling because of their personality, right? But I can't recruit everyone to be a certain type of personality. So what I did is I kind of deconstructed what a really good advisor did, and then just kind of made a process around it that anyone could do without having to have the personality to make it work. And so my call that we created, I can guarantee you today, there'll be 100+ advisors making calls, and they're all going to say within 90 to 95% of the script that I created 15 years ago. And that's, so you've got to have a structure in the script. You've got to make sure that, I guess the key thing with making a call is when I'm calling you, you've got to remind yourself up here that, Warwick's filled out a card or filled out a lead or told someone he wants to talk to someone about some financial products. So it's not a cold call. But when I ring him, he doesn't know my number. I've got 2 seconds to make him, aware that I'm not calling from a call center and I'm calling because you've asked me to, even though he doesn't really realize that yet. So it's being very clear at the start, hey, is that Warwick? Yeah, hey, Warwick, it's Simon here calling from Aurora. Hey, I'm just giving you a quick call because last night you were on our website or you were speaking to a member of my marketing team about having a chat around your insurances. Does that ring a bell? And I just shut up until he says something. And if he goes, oh, yeah, that's not good enough, right? So I'll go around again and say, no, it would have been on the site. You would have filled in this insurance. You've told me that you've got AIA cover at the moment. Does it? Oh, yeah. And until I get the aha moment, then I push on with the call. Because if I go past that without the aha moment, guess what? I'm going to get a no-show because Warwick's just gone, yeah, sure, yep.
What do you want to hear to shut up?
Sure, yeah. What was that all about? I don't know. And that's what I don't want, right? So I'd rather just go around in circles with you on the phone once it's clear. Hey, I was just giving you a call because you've asked me to. Oh, okay, crap. Now he's thinking, who did I ask to call me? It's not a cold call. And I could go on about how to get the call, but that's
well, the key part really, any cold call is the first.
But it's not a cold call, right?
Sorry.
Yeah.
Any call out of the blue.
I couldn't do cold calling. The cold calling, and I wouldn't expect my team to do cold calling. That's tough. That's hard. That's not financial advising. So you've got to go and spend the money on getting the leads or developing it. But you need to show them how, you make 10 calls, 6 of them say yes, 5 of them show up, 4 of them you meet, 3 of them you go back to, and 1 or 2 sign up every week. That's a career. That's a good life, and that can lead to bigger and better things.
Good little tangent we went on there.
You're welcome.
There's some sensational stuff in here. I think there'll be a great resource for advisors, and like with your experience, you've kind of been there, done it all, and you're still on the right side of 40. So congrats.
Thank you.
How do people get in touch with you if they want to find out more?
LinkedIn is the easiest way. Yeah. Obviously, we've got our client-based funding on the FIFO website. We will be rebranding at some stage. So, LinkedIn, Simon Rolland with 2 L's, and flick me a message if you're serious about growth capital or learning about how smart leverage can grow your business, especially in the KiwiSaver insurance or even mortgage side. If you want to connect, I'm always around and happy to help. So thank you so much for having me today. It's been great to finally meet in person. We've never actually met, right? So and it's a cool studio you got here. So really appreciate your time.
Dude, thank you so much.
Oh, cheers.
Cheers.